How will the recent changes to negative gearing affect investors and house prices is a question I've been asked. Firstly, to understand the difference in negative gearing, you have to understand that I have been against negative gearing from the start. It doesn't exist anywhere else in the world. If you make money on property anywhere in the world, you pay tax on it. And if you make a loss on property, tough shit, you don't get to claim back the tax on your income. And that's pretty much what the government have changed to in Australia now, so that you don't get to tax deduct any losses. And the simple example to give is if you're earning $100,000 now and you make a $10,000 loss on your property, then you're taxed as if you only earned $90,000. And so on that $10,000 loss, you might get $3,200 back off the government at the end of the year. And you might think, oh, great, that means I can afford the investment property and that rewards me for providing investments to the market. But the truth is, you're not. That house was there. The one that you just bought, it was already there. It was an established property. You didn't supply anything to the market. You just bought a house that a first home buyer could have bought or another landlord could have bought. It's different if you buy a brand new house. So if you buy an established house, you now no longer get the tax deduction of that $10,000 loss, but you do get to carry forward that $10,000 loss to future years. So if in a future year you make a $10,000 profit, you don't need to pay the tax on that profit because you're carrying forward a property loss. So over the long run, you're actually not going to be any worse off, but you are going to be worse off in the short term as an investor if you buy property after now. Those changes don't kick in until the 2028 tax year, starting on July the 1st, 2027, but you'll be impacted from any property you buy today under those new rules. Now, if you buy brand new property, which means you are helping to add to the housing stock, then the negative gearing still applies. And so it basically now rewards people for adding to the housing stock, and you get no reward for just buying an existing property. So for me, I think that's a good change. What will it do to the markets? Well, you have to understand in Australia, you've got lots of different property markets. And so different markets are going to respond in slightly different ways. The first thing to say is that Sydney has been struggling with borrowing power for the last 4 years and is already going backwards. I think this is going to help to make it go backwards further, which will make property more affordable, but is not great if you own a property at the moment. So that's the risk. In other areas where they've been growing rapidly, that growth was always going to run out of steam. And I think this is going to help that growth to run out of steam so that we start to see less growth in most of those markets. Some investors are going to throw their hands in the air and go, oh, I'm not going to do this anymore. But the professionals are going to keep going. Myself, I'm a professional investor. I'm going to keep investing. And so other people in that situation are going to keep going, that just the rules are going to work differently. Some people, though, will just go, it's too hard, I'm not going to do it now. And that's their prerogative. But that means if there's less buyers in the market for established properties, then those property prices may stabilize or come down slightly, which makes things more affordable for other people. Now, when it comes to the new stuff, the risk is if you're buying brand new property just to get the negative gearing benefits, you risk being conned into buying an absolutely rubbish property in a rubbish area built by a terrible builder, and just because it looks good on paper. And that's the risk that we see, is that actually we see investors could be getting conned, that any potential negative gearing benefits could see prices rise on those assets. Whenever we see more investors going to one particular group of assets, like new property, then what tends to happen is those prices rise, which of course then makes those properties actually a worse investment, because in 5 years' time, those properties are going to be established properties. They're not going to get the negative gearing benefits, and therefore when you go to sell them, they're going to compete with established properties. And if we get this disconnect between established properties being, which we see anyway, established properties being cheaper, new ones being more expensive, then that gap could get bigger, and it means that you're heading for a downfall if you come to sell it in the future, or we have to wait for a lot more market growth for that to catch up. So please don't get caught up in any of those scams and people trying to sell you on negative gearing being a great thing. It isn't. It just means you're losing money and the government will subsidize you, except now they'll only subsidize you if you're making a loss on new property, and they won't subsidize you if you're making a loss on established properties. Does that make sense?